The Standard & Poor's 500, more commonly known as the S&P 500, is a stock market index made up of the 500 largest publicly traded companies in the United States. It's often used as a measure of how well the stock market is performing and is one of the most important indices for investors. But what is the S&P 500 and how does it work? In this video, we'll break down the concept of the S&P 500, how it works, and its role in the stock market. What is the S&P 500? The S&P 500, or the Standard & Poor's 500, is an index of the 500 largest publicly traded companies in the United States. It is a broad, market-weighted measurement of the performance of these companies and serves as a benchmark for the health of the entire stock market. The S&P 500 is maintained by Standard & Poor's, which is one of the leading financial information and index providers in the world. The S&P 500 is a capitalization-weighted index, meaning that each company's individual weight in the index is determined by its market capitalization, the total value of its outstanding shares. This means that the largest companies have the greatest influence on the performance of the index, as their price movements will have a greater impact on the overall index. This makes it a better representation of the performance of the overall stock market than other indices, such as the Dow Jones Industrial Average, which uses price weighting instead. How is the S&P 500 calculated? The S&P 500 index is a market capitalization-weighted index composed of 500 of the largest U.S. publicly traded companies. The index is calculated by taking the sum of the market capitalization, stock price, multiplied by the total number of outstanding shares of each company and then dividing that sum by a divisor, which is adjusted for stock splits and other corporate actions. The components of the index are selected by Standard & Poor's and elevated on 4 key criteria: liquidity, financial viability, public float, and sector representation. A company must meet all criteria to be eligible to become a component of the index. The S&P 500 index is considered a benchmark for large-cap stocks and is considered a good indicator of overall market performance. It is also used to benchmark mutual funds and other investments against the broader market. As such, it's one of the most important indices in the world and is watched closely by investors, analysts, and traders alike. Some of the companies included in S&P 500. The companies that make up the S&P 500 are selected by S&P Dow Jones Indices, which is a division of McGraw-Hill Financial, and they are weighted according to the market capitalization of each company. This means that the larger companies have a greater influence on the index than the smaller companies. As of November 2020, some of the most well-known companies included in the S&P 500 include Apple, Microsoft, Amazon, Alphabet, Google's parent company, Berkshire Hathaway, Facebook, Walmart, Johnson & Johnson, and JP Morgan Chase. These companies make up the S&P 500 due to their size and influence in the U.S. economy, so investing in these companies can be a way to gain exposure to the U.S. markets. Investing in the S&P 500 has its own risks. However, since it includes only large-cap stocks and does not offer exposure to small-cap or international stocks. For investors who want a more diversified portfolio, there are other index funds available such as the Russell 2000 or MSCI EAFE Index. What major stock experts like Warren Buffett say about it? Warren Buffett, the legendary investor and founder of Berkshire Hathaway, is a huge proponent of investing in the S&P 500. Buffett believes that over the long term, stocks that are included in the index tend to outperform other investments. He famously said, "If you can't make money investing in the S&P 500, you can't make money investing." Buffett also believes that due to its diversified nature, the S&P 500 provides a safe way for investors to diversify their portfolios without taking too much risk. He believes that investors should not try to time the market, as it is impossible to predict what will happen next. Another investor who praised the S&P 500 is Ray Dalio, the founder of Bridgewater Associates. Dalio believes that the S&P 500 is the best way to get exposure to the U.S. stock market. He believes that while individual stocks may be risky, an index fund that tracks the S&P 500 provides investors with low-cost exposure to a wide variety of companies. Overall, major stock experts like Warren Buffett and Ray Dalio believe that the S&P 500 is a great way to get exposure to the U.S. stock market and should form a core part of an investor's portfolio. The S&P 500 is one of the most influential stock indexes in the world and can be used as a barometer to gauge the overall health of the U.S. stock market. It is made up of 500 large-cap companies, which are chosen based on certain criteria. The index is used by investors to determine how their investments have performed over time and can also be used to track broad market trends. Although the S&P 500 is an important indicator for investors, it should not be relied upon as the sole measure of success when making an investment decision. Investors should always consult with a financial advisor and conduct their own research before making any investment. Thanks for watching. For more views and updates, subscribe to our YouTube channel and stay tuned. Thank you.